Welcome to everybody. We just let in from the waiting room. We'll give it just another minute. There's still a few registered people who have not shown up. Then we will begin with introductions. All right, here we go. Hello, everyone. Welcome to the Practice Best Practice Taxes for Creatives workshop. I'm Den Santoro from S&G Project Gallery, and I'll be hosting the workshop tonight. I would like to start off by thanking our generous funders, Rockland Trust Charitable Foundation and Bedford Creative, and our partners, New Bedford Art Museum, Artwork, New Bedford Co-Creative Center, New Bedford Creative, New Bedford Economic Development Council, New Bedford Whaling National Park, Historic Park, and S&G Project Gallery. I also want to thank Lisa Aldrich, Eric Paradis, and Lisa Raiche for taking time out of their busy tax season to create this workshop content and to take the time to answer your questions tonight. This is our second workshop to be moved online because of coronavirus. So please bear with us if we have any technical glitches. And a few notes before we begin. Some of this is in the chat, so you can read some of this. But if you have questions during the workshop, please type them into the chat. Margot, Sonia, New Bedford Creative, and I will be monitoring the chat, and we will select your question. We will ask you to unmute so that you can ask your question out loud. This will give you the chance to do follow-ups as well. If you'd rather not be on screen, if you'd rather have us read your question, indicate that when you write your question in the chat. We suggest that you put your Zoom in speaker mode rather than gallery mode, so you see your focus is on who's talking. We also are going to have a short online survey at the end. We would appreciate you taking that survey because it's really helpful for us to collect some of the information. It helps us both know who our audience is and also to help us with funders. If you can also comment about the workshop in the chat, we save those, or you can send emails to contact@practicebestpractice.com with suggestions or comments. We also have resource documents on the on this workshop on the website on the workshop page, which is practicebestpractice.com/workshops.html. And you can download those at any point. We hope you've liked us on Facebook and signed up for our email list. And now, without further ado, let me introduce our presenters for tonight. We have three of them. Lisa Aldrich, who's president of Lisa Aldrich CPA PC. Lisa provides personalized, thoughtful accounting and tax services tailored to unique small business needs. Eric Paradis, who's a financial advisor, and is a financial advisor specializing in holistic planning and investments, and the owner of Massachusetts Financial Group. And Lisa Raiche, CPA MST, is the founder of Bodhi Business Advisors, business advisory and consulting firm supporting entrepreneurs in a variety of ways. We suggest that you read their full bios on the website. And now, without further ado, let me turn things over to Lisa Aldrich.
Hello, everyone. I am here today to talk to you about thinking about taxes, but really thinking about the accounting that goes behind those taxes. So I kind of tried to boil it down into 5 things to really think about when you're looking at accounting. I know it's a little scary subject for you guys. One of the easiest things to think about is just know your cash balance. Understand what you need to pay for coming up and what maybe cash is coming in, so you know what's available to you. One of the other things I always tell people is keep a separate account for your business versus your personal stuff. That goes for bank account and also for credit cards. Keep those things separate. You don't want the IRS having a look at your return and then having to look through your personal stuff and argue over it. It's always best to keep those things separate. You don't have to obsess over your cash balance. Just know what it is. Just know whether you can pay your bills this month and where the money's coming from. And if you know that you can't pay your bills, it helps you kind of come up with a plan to figure out what you're going to do about it. The second thing you can think about is really keeping your accounting records up to date. I know that sounds kind of daunting, and I know a lot of people wait and do them all up once a year. I don't recommend that. You are running a business. You will need, at some times, for example, to apply for a PPP loan, you will need to know what your results are so that you'll know if you qualify. Or grants, same thing. So you need to develop like a high-level process just to figure out what your basic income and expenses are. I suggest doing it monthly. Take an hour a month, throw in as much as you can. Don't worry about the rest. But that would be my suggestion. It doesn't have to be fancy. You don't have to use every account in QuickBooks. You don't have to use every function in QuickBooks. I don't think that really matters. I think you really just need basic information that is meaningful to you. So keep it meaningful, and don't try to utilize inventory assemblies if you don't need to. Don't try to utilize don't try to itemize your merchant fees unless it's really meaningful to you. Do you really need to know your Shopify merchant fees versus your PayPal merchant fees? May not be really helpful. So if it's not, boil it down and and just post merchant fees and move on. That would be my suggestion. Revenue, keep it to 1 or 2 categories. Same thing. You don't want Shopify revenue versus Etsy revenue. You can get that right on your site, right on your revenue channel site. So I wouldn't put it in your QuickBooks. I don't think you need to. Let's see. Your profit and loss should not be a surprise in April. It is helpful for tax planning, and it is helpful to know when your business is growing. When businesses are growing, they usually are short on cash because you need to buy your supplies ahead of time. You need to pay your people. If you have payroll, you need to pay your people ahead of time before your sales even happen. So it's really important to have a handle on what your accounting is so that you know how you're going to fund those expenses. And you may need to connect with a bank. And so you need to know. Third thing I would tell you is don't spend more than an hour updating your accounting records, because I would suggest you use automated feeds. It's, in QuickBooks, there's a nice automation where you can download your bank data, your credit card data. You don't have to put everything in. It saves you a lot of time. You just have to look at what's coming in and say, yep, okay, this is a bank fee. Okay, this is materials. This is a subcontractor, whatever it is. And it'll save you a lot of time, and it's just, that's going to be putting your time spent in the right place. Let's see, what else do I want to tell you? My fourth point is understand the basics of a balance sheet. I know that most people don't know what a balance sheet is. They know what a profit and loss is. Absolutely true. Profit and loss is really important. There's a lot of income and expense items that do need to get on your tax return, and most people care about how much money am I making at the end of the day. Balance sheet tells you what you own and what you owe. Things you own, things like cash, receivables, maybe some inventory and maybe some equipment. On the receivables, you want to keep track of that. If you have people that, you do a sale now and you get paid later, you're going to want to track that and make sure that you're on top of those and make sure that everybody actually does pay you. You want to follow up on those sooner rather than later. What you owe things like credit cards, vendor payments, payroll liabilities. Here's my plug for get a payroll company, please. Doesn't have to be an accountant, but get a payroll company to run your payroll. Don't try to do it yourself. It's too complicated, and there's a lot of personal risk that's associated with that. And then also the other thing you might owe is loans. Again, it's just helpful to know kind of what's going on. I always compare this year to last year. I think it's really helpful to understand, am I doing better or worse? And in what categories? And, why am I doing better or worse? Does that make sense? Did I make a data entry error when I did my counting? It's all important stuff. So to finish up with tax returns, got some do's and some don'ts. My suggestion is claim all your income. don't try to get cute. Claim all your legitimate expenses. Again, I see more effort put around trying to make a lot of different deductions that aren't actually legitimate and missing the actual legitimate ones. So really be really careful and talk to your accountant about what you can and can't deduct. Don't try to deduct personal expenses. Do keep a mileage log. Do keep a log of your business meals. Do claim all your income, because the other reason is that in looking at creatives and the arts, you want to make sure that you're making a profit 3 out of 5 years. The IRS actually has a profitability rule, and they specify that you must make a profit in 3 out of every 5 years. And if you don't, you're at risk of being classified as a hobby. So you can't lose money year after year after year. I see it in a lot of the smaller side gig things like the shake companies and things like that, where somebody wants to buy in and get their product for cheap. So and they claim it's a business. The IRS doesn't really see it that way, so you want to be really sure that you're claiming all your income. Don't claim a home office unless you actually have an area set aside for just your business. Storing stuff, storing your materials, working on your workshop, things like that count. Claim all your barter arrangements. So if you barter for services, just claim it. It goes on a Schedule 1099B. It's important to make sure you claim everything, because again, you're going to boost your income and your expenses. It's going to be appropriate and important. When you apply for loans, they're going to look at revenues. It's just a really important figure. Know the rules about who's an employee and who's a contractor. Those are critical things for you. It's a lot of risk. If the IRS comes back and classifies your contractors as your payroll, that's going to be a problem for you. So make sure you're clear on what those specifics are. And make sure you issue all your 1099 NECs. That's the new form this year. Make sure you issue those to all your contractors. Make sure that you're including your accountants, your attorneys, your repair and maintenance contractors, advertising, rent to your landlord. That goes on a 1099 miscellaneous, things like that. All business services over $600 get a 1099 if they're not incorporated. And talk with your accountant about what you can legitimately deduct, whether you need to make estimated payments. Those are always important, which again is easier if your accounting is up to date and if you're making more money than last year. And then talk to your attorney about your accountant about alternative business structures, things like LLCs, S corps, incorporating, and things like that. It may work for you, it may not. So look at that. And then also talk to your accountant or your financial advisor about retirement plans. So we're going to listen to Eric Paradis talk about retirement. Eric, you're on.
I guess that's my cue. Nice segue. Thank you, Lisa. So investment world could be its own entire presentation, right? But the reason that I think I'm here today is because there are ways that you can save money on taxes by putting money away into retirement accounts. So before we talk about what those retirement accounts are, let's just talk about the very basics of investing, okay? So what is a stock, all right? A stock is, let's say I own a company that makes widgets, ABC company, and it's worth $100. And I sell 10 shares of the stock. Each share of stock would be worth $10 because the company is worth $100. So each share is worth 10 bucks. You buy one share of my company for $10, and you hope that the value of my company goes up over time. And if the value of my company goes to $300, now the value of your one share is now worth $30, okay? So that's what stocks are all about. You see them on TV, you heard about them all your life. You actually own a share of a company. Now, a bond, on the other hand, is like a loan. So you give my company a loan of $1,000, let's say, and I give you an interest payment every single year that I hold that $1,000, and that's the coupon on the bond. And after 10 years, The company pays you back your $1,000, but each of those 10 years, you've been earning an interest rate, let's say 5%. So you get $50 a year on that bond. And bonds are another way to invest in companies. So it's very difficult and risky to invest in individual bonds and individual stocks. It can be very costly, and there's a lot of volatility involved, because if you own a stock in my company and my company goes down the tubes, your one share that's worth $10 when you bought it could be worth $0 if my company goes belly up. So there's a lot of individual company risk when you invest in one company. So the mutual fund was invented in 1924. So what the mutual fund does is it takes a basket of stocks. So a company will manage a mutual fund for you. And there'll be anywhere from 100 to 300 different companies inside this one basket of stocks. And then you buy a share of that entire basket. So you could liken it to a bucket of water that everyone puts a different temperature coffee cup into. And somebody's got cold coffee, somebody's got hot coffee. You put it all into a bucket and it's an average temperature, right? A mutual fund is very similar to that. Some stocks do very well, some stocks do poorly. But when you buy into a mutual fund, you're buying many, many stocks all at once in small little pieces. And it takes a lot of the risk and volatility out of the investments for you. There's something relatively new compared to mutual funds anyway. They're not new anymore, but they're called ETFs, or exchange traded funds. I'm going to be very simple on this. I don't want to get too deep, but exchange traded funds are a lot like mutual funds. They tend to be managed a little less. They have lower expenses, and they're traded throughout the day like stocks. Mutual funds are only traded at the end of the day. That's not important for this conversation, but it's another way to diversify your investments. Now, how does all that relate to taxes? Well, we hope that you're doing well with your business, and we hope that you can take some of the money that you've earned and actually put it away for retirement. In doing that, there are a number of vehicles that the IRS and the United States government have set up so that we can save money on taxes, because they're motivating us. They're saying, listen, we want you to put money away for your retirement, the IRS is saying, or the government is saying anyway, because we don't want to have to take care of you. We don't want you to rely on Social Security alone to retire on. So they've set up a number of different places that you can put money in order to save money on taxes. So the oldest in the options for this are the traditional IRA. Now, a traditional IRA does not make or lose any money. It is simply a wrapper that goes around the investment that you choose. So you could choose to buy a stock, a bond, a mutual fund, an ETF, and that's the investment, okay? The fist in my visual analogy here. And then the traditional IRA is the wrapper that goes around it that tells the IRS how to treat that investment for taxes, okay? It's that simple. So the wrapper is simply, doesn't make or lose money. It just tells the IRS how you make or lose, how it's treated for taxes. So if you would put money into an IRA, you can put $6,000 a year into an IRA. If you're 50 and over, you can add an extra catch-up provision of another $1,000. And each calendar year, you can put up to that amount. You don't have to put the whole thing. You can put up to that amount. And whatever you put into that traditional IRA, you do not have to pay federal income tax on, okay? So if you're in a 20% tax bracket and you put $1,000 into the IRA, you don't have to pay income tax on that $1,000, which means you save $200 in taxes. So in the end, it only costs you $800 out of your pocket to put $1,000 into your IRA, all right? That's one kind of IRA. Keep in mind, IRA, the traditional IRA is treated for taxes the same way as a SEP IRA, a 401k, a 403b. These are all different kinds of tax wrappers, and it all depends on if you have an employer. So if you have an employer, you have a 401k. If you have a nonprofit employer, you have a 403b. If you work for a municipality, you have a 457 plan. These are all fancy names that you don't have to remember. Just know that they're all treated the same for taxes as a traditional IRA. Now, The Roth IRA is, again, not new, but relatively new compared to the traditional IRA. The Roth IRA is treated completely different from from a traditional. It's a tax wrapper, okay? So the Roth IRA is just a different kind of wrapper. The Roth IRA says, okay, you can put $6,000 or $7,000 if you're over 50, in $6,000 into the Roth IRA each calendar year. Now, the money you put into the Roth IRA does not give you a break on your taxes for that year. Okay, you use after-tax money, you pay income tax on that money. But as that investment grows, and hopefully the investment that you put inside the Roth wrapper grows, as that investment grows, you will never pay income tax on any of that account as long as you take it out after the age of 59 and a half. So the Roth IRA can be a very powerful planning tool because it diversifies how your investments are treated for taxes, but it also gives you a way, if you have a long time between now and retirement, it can be a much more tax efficient way for you to invest in the long run, because as you pull that money out when you retire, you can pull it out completely tax-free, as opposed to the IRA 401k world, where as you pull that money out, you will then have to pay income tax on it. So let's say you're very successful, you have $1 million in your traditional IRA when you retire, and you pull out $100,000 in one calendar year to live on. You will be taxed as if that $100,000 is income, okay? But while that money was sitting in the account under the traditional IRA wrapper, it grew tax deferred that entire time. You didn't have to pay any money, any taxes on it when you put it in, and you didn't have to pay any taxes on the earnings as it grew. Why is that the case? Well, we've all had savings accounts, and the banks pay us interest, albeit a very small amount. It's almost painful to talk about. But at the end of the year, you get a 1099 for the interest that you've earned in that bank account. That bank account is an investment, and it doesn't have a special tax wrapper on it. The investment is the savings account, and the wrapper is an individual account that just has your name on it, which means that any gains that you have inside that account are taxable to you. That's why these tax wrappers like the traditional IRA, the Roth IRA, are so important, because they allow your investment to grow without being taxed year after year after year. So the Roth IRA gave us another way to invest. Now, again, keep in mind when there are qualifications for contributing to these IRAs. And if you're married, you have to remember that the income of your spouse also is included in your qualification for these different kinds of accounts. So, I mean, I can share my screen with you and show you the limitations, but to be honest with you, what I really want you to know is that there are some limitations to contributing to them. So if you earn too much money, you can't contribute to a traditional IRA. There are other vehicles out there like a SEP IRA. Now, being individual business owners, you may have heard of a SEP IRA in the past. The SEP IRA allows you to put away money on a tax favored basis, not only income tax favored, but also to avoid FICA and Medicaid. Now, if anybody understands what the FICA Medicaid relationship is, Lisa may be able to explain it more than me afterwards, but you basically have to pay both ends of FICA Medicaid. If you work for an employer, they pay for half, you pay for half. But when you're self-employed, you have to pay both ends, and it's about 15% in addition to your income tax. When you use a SEP IRA as a vehicle, as a tax wrapper, you can actually put money in that IRA for yourself and not pay the income tax and also not pay the FICA and Medicaid tax. So it's a double tax savings. This is a very, very powerful vehicle. What a lot of people don't know is that there's something called an individual 401k. This is very powerful. So if you're successful, or you're, again, you have a spouse that also earns enough money that you can put a significant amount of money away, and your business is successful, you can really save a great deal of money. You can put away as much as you can in a SEP, but you can also put out an additional amount of money away. You can put up to $57,000 a year without taxes into one of these plans each and every year. Now, you have to earn that much money and then some in order to get that much money into the plan. But just know that there are things out there that allow you to defer a lot of money for taxes. It saves you money on income tax right now. It saves you money on taxes on the growth of those investments as they grow. And then later on in retirement, they can have great tax benefits. Okay, one of the things that we thought might be interesting, especially given what's going on in the news recently, is these online trading accounts. Robinhood is a very popular one right now, especially with the younger generation. Schwab, Fidelity, TD Ameritrade, these are the more common ones where you can buy and sell stocks, ETFs, and mutual funds. All of these trading platforms now, almost all of them, I think all of them now, offer free trading. So you don't have to pay any trading fees to make those trades. But there's nothing wrong with doing it. Just know that if you invest in an individual stock, it can go up really fast and it can go down really fast. Just understand that there's a great deal of risk when investing in those things. Now, there are more complicated trading instruments you can use, like shorting a stock. You can lose a lot of money in these. You can lose a lot more than you've invested. So just know that if you're going to get involved with these, educate yourself as much as possible. You can even talk to somebody like me, a financial advisor. They can help to educate you a little bit more before you get involved with them, because it's not just about gaining or losing the money. It's also about the potential tax consequences. If you gain a lot in an investment in one of these accounts and it has an individual tax wrapper on it, meaning you get taxed on gains, when you sell that security, you're going to have to pay a capital gains tax on the growth. So if you buy it for $10 and you sell it for $50, you have to pay capital gains potentially on that $40 of difference. Okay, so it's not just investment growth and I'm happy and I can walk away with my profit. You've got to make sure that you're prepared to pay the taxes at the end of the year. That's why it's so important to use a tax professional to prepare your taxes, especially if you're investing, especially if you have a business, because there's so many ins and outs to the tax code that it's very difficult to keep up with. People like Lisa and Lisa do that every day and they keep up with it. It's worth every penny to use them for their services. I included a number of PDFs on the website that Den has made available that talk about more details about investing, the different ways that you can invest, and the kind of tax savings potential that's there. So if you have any further questions, you can obviously put them in the chat, or we can talk about it later in this, or refer to those PDFs. They can be very helpful, but more designed as a conversation starter. I will now hand it off to Lisa Raiche, who is our second tax professional.
Good evening, everyone. Thanks for having me. I joke with people and I tell them that I'm a creative trapped in an accountant's body. I don't know. At this time of the year, sometimes I have to get a little creative on some tax returns. But just to kind of piggyback on what Lisa said, it's super important for you to keep accurate records as well as keeping your accurate records throughout the year. You don't want to come in and see your tax professional at year end and ask them, did I make money? Because I've had that happen far too many times. So we're going to talk about some basic concepts. I know tax is not a super sexy topic, so we're going to kind of keep it pretty simple. But first thing is, I would expect most of you are probably filing as a sole proprietor, and you'll be filing what is a Schedule C on your personal tax return, which is your 1040. And basically what the Schedule C is it sums up your revenues, your expenses, and your net profit. And your net profit, you're going to pay something called self-employment tax on that. And Eric just kind of touched on it quickly, but I'm going to go in a little bit deeper on self-employment tax. And self-employment tax is basically a tax of Social Security and Medicare for a person who has a business. Not very different from when you work for someone else. And this is, I think, the piece that catches a lot of new business owners up that first year is they're not expecting to pay the self-employment tax. And so depending on what your net profit is that year, you're paying 15.3% tax, self-employment tax on that net income. What is that? When you worked for someone else, you would have gotten your paycheck possibly every other week. You would have had federal withholding there, state withholding, Social Security withholding, and Medicare withholding. Your Social Security and Medicare withholding on your paycheck was for a total of 7.65%. When you work for someone else, you don't realize that that employer is actually matching that 7.65%. And so there's a total of 15.3% that goes to Social Security on your behalf. What you don't realize, and many people don't understand, is when they start their own business, they're basically on the hook for that entire 15.3%. So if you have a, again, you net $10,000 that first year, you're looking right off the bat at $1,500 in self-employment tax on that money right out of the gate. And if you're not expecting that, that's a really big dollar amount to swallow, especially if you don't have any money put to the side. And so what's so hard for the first time business owner to really understand is they're paying the self-employment tax, the 15.3%. They're also paying income tax. And so when you worked for months all those years, they were putting the money to the side for you every pay period, every week, every other week, twice a month, however often it was. When you work for yourself, you now have to take that into consideration and either put the money to the side throughout the year or put the money to the side and make quarterly estimates. So it's important for you to understand on a quarterly basis where your business is at so that you can make a relatively accurate estimate of what your tax is. Because if you aren't putting estimates to the side, you put your self-employment on that first year, your income tax, and now suddenly maybe you owe $7,000. It's possible when you work for somebody else, that's what you paid, but you didn't see it come, that money went to the feds in the state every pay period on your behalf. So it's a big dollar amount for you to kind of get over. Some of you are married or filing jointly with a spouse. That little bit of extra income tossed onto someone else's income could also potentially put you into another tax bracket. So you could be at a 25 bracket and suddenly you make a little bit of extra money in your business. You're paying self-employment on that, plus income tax, and now you've moved out of the bracket that you were in, and now you're in another bracket, the next one up. So you want to take that into consideration, that it's not, if you are filing jointly, or even if you aren't filing jointly, if you are working a number of jobs, if you have a number of jobs and you're earning a little bit of money on each one of them, when you start to aggregate all those jobs together, you throw some business income on there, you may have a significant tax due that year. So keep in mind that you want to have an idea in total what you think you're going to earn during the year from all of your sources of income. Similar to what Eric was talking about, you don't want to be blindsided at year end when you realize that you had stocks. Someone, you got it when a relative passed and you decide to sell it this year and now there's capital gains on there and so on and so forth. So number one, definitely as a business owner, you've got to know what you're earning on a quarterly basis so that you can, if you don't send estimates in, fine. I fight with taxpayers all the time, but at least know what you're going to owe at year end so that you're not blindsided as to what you're going to owe, because I've had far too many uncomfortable conversations with clients about what they could owe. Next, what is deductible? The service says what is deductible is anything that is an ordinary, necessary, and reasonable expense. So let's see, I found another pretty good definition. So this one states that any expenses that are helpful and appropriate for a business. So if you are a painter, your Porsche Cayenne is probably not tax deductible. So while I completely agree with Lisa, you want to take all of the deductions that are you are eligible for. There is a time and a place to be aggressive, and that is probably not the place. Mileage is a big one. It's a one that could be quite lucrative, but you want to maintain a mileage log. If you do not have a mileage log and you end up in an audit situation, that is a very quick way to have deductions disallowed. So if you're an artist and you're painting supplies, if you're renting a studio space, if you're driving to the art shop to buy your supplies, that mileage all qualifies. If you are the type of performer, if you dance for a living, you probably are not going to have a lot of expenses. Keep that in mind when you are earning your income, because a good majority of what you earn is probably going to be taxable because you're not going to have a ton of expenses. A lot of service-based individuals that I work with are very surprised when they owe so much tax, but the reality is they don't have a ton of overhead. You as a performer, an artist, you're not a manufacturer making widgets. You don't have a factory, you don't have equipment, you don't have a team. Those all cost a lot of money. So keep in mind that as a performer, as an artist, you probably aren't going to have a ton of expense. So don't be surprised when you earn on paper a little bit more money than you had actually expected. I'm going to go over just a couple of pandemic related things. One of the big things out there right now is they call it the RRC, the Recovery Rebate Credit. In short, that's your stimulus payment, right? Is your stimulus payment taxable? It is not taxable to you. But when you go to file your tax return, you need to know if you received any of your stimulus money. So if you've received stimulus 1 or stimulus 2, and how much you earned. It's important because if you did not receive the stimulus money, and if you are eligible for the stimulus money, then you could potentially earn a credit on your tax return for money you did not get back in May, June, or back in December when the second batch came out. So it's important that you have that information on hand when you go to file. There aren't any, you didn't get anything in the mail regarding, notices that you received it. It's just, you need to know. So that's important. Your preparer is going to need to know that you received those funds or you did not receive those funds. Another big thing, another big thing with pandemic aid, some of you may have filed for unemployment for the first time in your lives this last year. Your unemployment is taxable. It is absolutely taxable to you. For some of you, if you did not have any federal or state withholding on that unemployment, you could potentially have a decent tax bill this year, especially if you are filing jointly with a spouse. So I've already had a couple conversations. Young woman, small business, typically does not make a ton of money, typically does get the earned income credit because she has 2 children. She does not qualify for the earned income credit in 2020 because she had $18,000 or $20,000 in unemployment income that did not have any withholding on it. So now she has a tax bill, plus she didn't get an earned income credit like she historically would have because she went over the income limitations. So keep in mind that unemployment could potentially cost you some money this year. Another couple, let's go over some kind of basic other pandemic aids. So PPP1, if you applied for PPP1 as a sole proprietor, I would recommend that you get your forgiveness application in. It's actually pretty simple for a sole proprietor. You want to make sure you get forgiven as soon as possible. Now, PPP2 has just come out. Now, there's been a whole hoopla of things that have happened in the last 2 days. So some of the banks have halted taking applications right now. But in order to qualify for PPP2, you need to have at least 1 quarter in 2020 where your revenues, so if you're a cash basis taxpayer, which most of you probably are, you will have to have 1 quarter in 2020 where your revenues were 25% lower than they were the same quarter the prior year. So for example, for most people, that's going to be Q2 of 2020. That would have been April 1 to June 30. If your revenues April 1 to June 30 of 2020 were 25% lower than they were in 2019, then you would qualify. That's just an example, but it has to be 1 quarter over 1 quarter from the prior year. This, going back to what Lisa said, is where it becomes incredibly important for you to have your financial information at your fingertips at all times. Because if you don't have this information right now, you're going back and you're digging through your financial info, your bank statements, the invoices that you sent out to potential customers, clients, so on, and you're trying to recreate this information. You don't want to be recreating this information when you're attempting to apply for a grant or get this PPP. Now, with PPP2, the new caveat or the brand new wrench that the president threw into things on Tuesday was you have the ability, they're going to change the rules on how they calculate what you're eligible for. So previously, what you were eligible for was based off of your net income. Because many businesses were closed out of that because they weren't profitable in 2019, they weren't eligible at all. So they're changing the rules that your eligibility is going to be based on your gross income. Again, if you don't have that information put together, you've got to hurry up and put it together because you're going to need it if you want to apply. I do know a number of the banks have halted applications, so you would have to make sure that you find out exactly when your bank is ready. A number of the Fintech Banks have been really wonderful through this process. So if you are with a bank that did not accept PPP, for instance, Bank 5 in this area did not accept PPP, there are a number of Fintech banks. There's Radius Bank, there's Cabbage. Those Fintech banks were taking people who were basically displaced by other banks that weren't working the program. It's also another reason for you to have a relationship with your banker. Really important for you to have a good, solid group of professionals that surround you. That's your accountant, that's your attorney, that's your financial advisor, that's your banker. Regardless of the size of your business, there's probably going to be a time somewhere along the line where you're going to need those people. So it's important that you build those relationships. There is a second round of the EIDL Advance, which is basically that maximum $10,000 grant available. Basically, the SBA has chosen the group of people that would be eligible. There's a specific pool that they're picking from, but basically, in order to qualify for this potential grant, you have to be in what's considered a poverty zone as outlined by Internal Revenue. So in most cases, if you qualify for this, the SBA is going to reach out to you with an email to state that you are eligible and please apply. Again, that's another option for potential pandemic funds. A couple of other credits available. The credits at this point are basically credits related to employees. So if you don't have employees, these probably don't pertain to you. But just quickly, there's something called the Employee Retention Credit, and it's a refundable tax credit equal to 50% up to $10,000 in qualifying wages. It's all based on the payroll taxes that you paid in. So basically the FICA, the Social Security, Medicare you paid in for employees. I did hear a whisper that there is a possibility that some version of the ERC is going to be available to self-employed individuals, at which point they would be able to, their tax would be, they'd be able to defer it out a year or so before they had to pay it. I heard about that early on in this. I have not seen anything since, so don't tie me to that one, but keep your ears open. There could be something eligible. There could be something that's available to self-employed individuals related to what they paid into FICA. The other is the sick and family leave credit. And if you have employees and those employees were out during 2020 for themselves with COVID, or they were caring for a family member with COVID, and you paid them because under the CARES Act, you had to pay them, you are eligible potentially for credits on the payroll taxes that you paid into that. So just a couple of extra things for any of you that may actually be incorporated with employees to kind of keep in mind. Those are additional credits. Just another couple of quick little things. Standard deduction for this year is single person is $12,400, joint filer is $24,800. For many of you, a couple of years ago when they changed the standard deduction rates and they basically doubled, many of you that were itemized filers are no longer itemized filers because the standard deduction is so large. Keep in mind, if you are no longer an itemized filer right now, there is also an additional deduction of $300 for giving to charity. That's not, historically, charity would be on your Schedule A, which is where you itemize. If you're not itemizing, but what they're saying is an above the line $300 tax deduction for charity for people who don't itemize. And it's kind of a high level of the tax. We can dig into any other specific questions people have. Feel free to shoot us any questions you have. That's really high level. I can get crazy minutia and bore everybody to tears for another hour, but I don't want to do that. I'd rather answer questions pertaining to their own issues.
Okay, well, that was a whole lot of information. I'm sure that there are people out there with questions. So if you type some questions into the chat, we'll put you on screen, or we'll read your questions for you, and we'll find out more details, because you know your situation and we don't.
While we're waiting for questions, I just wanted to throw a couple of things on here that I thought were good. A lot of people who are running their own business, sole proprietor, a lot of these concepts may be new. And I think it's worth saying that just keeping records about what you spend as an expense for your business isn't enough. You have to have the receipt. And a lot of people don't realize that, right? They just give a bunch of numbers to their tax preparer and say, oh, I spent $7,000 on canvas this year. Well, okay, if you get audited, the IRS is going to want to see the receipts that you actually spent that money. So this leads into the second suggestion that I have for everyone, is that set up a box with folders or a filing cabinet, and each file should be a different category. And at the very least, if you're not using QuickBooks, if your business isn't sophisticated enough yet to get to the QuickBooks stage, at the very least, keep a folder that's labeled with each of your major categories. Income from different sources should have its own folder. You should have a folder for supplies. And if you want to get specific with the kinds of supplies, that's a whole nother story. And rent, education expenses, have each category that you work out with your tax preparer, develop those categories over the course of a couple of years, and then keep files for each of them. That's a really simple way to do it. Now, this is something that I talk to a lot of my clients about, because I do, as Den had mentioned, I do holistic financial planning. So a lot of what we do isn't investing and getting down and dirty with tax write-offs and all of that. A lot of times it's simply doing a budget, right? And one of the tips that I give people is do your bills 2 times a month, on the 1st of the month and the 15th of the month. No bill that you get, for the most part, can't wait 15 days, okay? What this does is it helps you think about your finances, or the bills part of your finances, 2 times a month, rather than every day you get something in the mail. Oh, I got to pay this bill. No. Put it in a small pile. On the 1st of the month, address the pile. Open everything, balance your checkbooks. If you balance, that would be nice if you did. And then pay all of your bills. Then put all the bills on a pile for the next 2 weeks. And on the 30th or the 28th of the month, whatever it is, know that you've got to address that pile again. And at that time, like Lisa Aldrich said, update your records, right? Make a list of all the expenses, the allowable expenses. Make a list of all the income that you brought in and keep all of that. And if you're using QuickBooks, make sure the QuickBooks is updated. If you're not using QuickBooks, use a spreadsheet. If you're not using a spreadsheet, use a ruled-lined paper at the very least to keep these records. And then that, I know the tax preparers are
Disagree with
cursing
the
me
rule
for
of
saying this.
paper.
I know.
No green
but
bar, please.
Some
Sorry.
people have the very simple setups. If you're not doing a lot of volume, if you're doing volume, you've got to use these systems that the leases are offering, are suggesting. But those are some areas that I wanted to kind of bring up.
And your receipts do not have to be paper. You can scan them and they can be in electronic format. You just want to ensure that your scans, your pictures are good quality. I years ago worked in corporate. We'd get expense reports, and I swear I did not know where they were taking their pictures from. I used to get pictures that looked like they were taking them from 4 stories up off of a roof. And I was like, how the heck am I supposed to pay you on this? The service is going to do the same thing. If they can't read it, they're not going to take it and they'll disallow it. And I've been through enough audits where clients didn't have enough documentation and they disallowed because we didn't have enough receipts to support all the numbers on the return. That's a very real thing that happens. And I will also kind of scare you all, and that's not my intention, but I'm going to go ahead. Once you get to a point where you have a business, you have investments, you have a rental property, whatever it is, please seek out a professional to do your return. I went through a tax audit. A woman did her own return in the early days of TurboTax. She took a legitimate number and she put it on the wrong line. And when basically the returns go in, they get graded, okay? And the grade that came out was not within the parameters that it should have been, and she got pulled for audit. And because she was pulled for audit and she was unable to substantiate some of the expenses, she had a bunch of them disallowed. And so instead of spending a couple dollars on having someone prepare her return, it cost her probably, I think it was $12,000 or $15,000 between adjustments on her tax return, us to represent her for an audit that went on for about 16 months on and off. I mean, it's expensive. So most of you are probably very intelligent. And when you have just the W-2, you can probably follow the prompts in TurboTax. I completely believe people can. Once you start to get a little bit more complex in your returns, please seek out professional advice.
Can I ask a question about the receipts thing? I was told many years ago that a credit card statement is functional as a receipt, and particularly if the credit card is strictly used for business expenses. Does that still hold?
You really want to have that original receipt to go with it. I mean, it could be just about anything at that point. I will say when it comes to like recurring type of things, they'll usually pass it. For that G Suite, subscription every month and that Microsoft subscription, they're not looking at that minutia stuff. Typically what gets pulled, mileage is a doozy, meals. The service doesn't think your Dunkin' Donuts every morning is deductible. It's not an ordinary necessary expense. You think it is, but they don't think it is. So those are really big things. And I agree with Lisa. Compensation, especially for an owner, a business owner. Reasonable compensation is a very big thing. They will make an adjustment. I've been through those audits where they don't, you think you're going to take $10,000 in salary for your business, and they come in and they're like, no, because someone in your industry doing what you do at your revenues, et cetera, should have earned X, and they'll make an adjustment for it. So, those are all things that you want to make sure that you're aware of and that you don't get blindsided, because those are really expensive things that you could have gotten in front of in advance.
And on the meals, the other thing you want to think about is if you do have a legitimate meal where you meet with a supplier, a customer, a potential someone, even networking, something like that, you want to write right on the receipt who you met with, basically what you talked about. It doesn't have to be this discussion. It just has to be basically what you talked about. And make sure that's written right on the receipt. And then when you scan it, I mean, keep it electronically. You know, receipts do degrade. So that would be my only thing about putting it in a folder, Eric, is if you scan it now and it's thermal paper, it will live on for a lot longer. And if you write down who you met with and that kind of thing, it's right there. It's obvious, and it will hold up a lot better in the audit.
I have noticed my receipts have degraded over time. You're absolutely right about that. They're almost unreadable. And the irony behind that is that the IRS can audit you up to 7 years back, but if you make an error on your taxes, you can only go 3 years back. So just keep in mind, everybody, that receipt has to last 7 years. And if you do go the electronic scanning route, just remember, you got to have backup of that, because if you lose the device that it's scanned on, you are up the creek.
Absolutely.
Hi, I had a question, and I put it in chat, but anyone listening to the recording might not see it. What is the average fee? Is there an average fee for professional tax preparers?
No.
I agree.
You get what you pay for. I'm sorry. Was that blunt?
Yeah, I agree with Lisa. I mean, I think it really, every fee depends on what you have going on. So, and every tax return, there's a lot of uniqueness out there to it. It depends on how much time and effort is put in, really. And that's.
I used to tell clients that it costs you money to have me open your envelopes, because I used to get clients' information still in the envelopes. So their W-2 from their employer was still in the envelope. The 1099 from the brokerage company was still in the envelope. Costs money for me to open those envelopes. And they wonder why their return was so expensive.
Thank you.
You're welcome.
Yeah, I mean, my husband and I have a tax preparer for at least 10 years now, and it's been worth every penny that we paid in a fee, which hasn't been that much. So yeah, I do highly recommend it.
And could you?
Yeah, it only takes
could you tell
1
us-
year of doing something wrong and then ending up having to pay for it a few years later to justify the expense of paying someone to do even a simple return. And I recommend all my clients do that.
We have a question from Betsy Gorin. Hang on a second, we'll unmute you. You can unmute yourself now, Betsy.
Hi, so I've been doing my own taxes using the H&R Block product for many years. I retired a year and a half ago from an employer type job. I was a visiting nurse. And now I'm trying to do a lot more with was a hobby, but I want it to be a business. I'm a polymer clay artist and I live on the Cape. So how would I go about finding someone, an accountant / tax prep person? Any suggestions?
A friend first.
So
ask around, absolutely, because people will tell you who they love. And sometimes you'll hear about who maybe burned them too. The other thing is that now honestly, without the electronic in this day and age, your preparer could be anywhere. And so you just really need to find someone that you know, like, and trust, or that has, that a colleague or a friend or a family member knows, likes, and trusts, and you feel comfortable sending your information to. So
Okay.
that's kind of that's my first. I would always start with your inner circle first before you kind of Google CPA near me kind of a thing.
I wouldn't do that. Yeah.
Yeah.
That's why I asked the question. Yeah.
The other thing you can try is Facebook groups as well. And the other thing is, call, like if you get 3 names, call them all, talk
Mhm.
to them.
Yeah,
and
I agree.
see who you like.
What kind of questions would you suggest they ask to when they're actually talking to them and sizing them up?
That's a good question because I work strictly with business owners. I don't do individual, like I do individual, my business clients. I don't do individual returns anymore, but that's a good question. I mean, maybe some questions related to your, so you're retired, so you have retirement, so you have retirement income. You know, maybe ask some tax questions related to the fact that I have a business now. Maybe just little things like what should I be looking out for in terms of, you know, what should I know? What can I deduct? Just little things like that, kind of pick their brain, see what they have to say. I think.
Lisa, I think you answered the question without answering it because you said that most of your clients are business owners. So one of the questions you should ask a tax preparer is, what are most of your clients like? Who do you serve?
True.
Right?
Yeah, exactly.
So
There
you
you
may
go.
find people who like to specialize, and that may be the person that you want to go with. And a lot of times, to me, it's really about rapport, right? So if you get along with the person too, I mean, most tax preparers, let's hope, are going to be professional and know the code and do the CE. So that's the hope that they're doing that. So if you get along with someone and someone that you enjoy picking up the phone and talking to, and vice versa, then that can be good.
You're right, because I actually specialize in businesses, and I would say to you, oh, gee, you know, I don't do individual returns, but I have 3 colleagues that I can refer you out to, and you're right. You want to ask that question. Eric's right.
But also to Eric's point, you want to make sure that you're comfortable talking to this person. You want to be able to, you want to feel like you can pick up the phone, and you want to feel like you want to pick up the phone. You don't want them to intimidate you. That shouldn't be part of it.
We have a question from Todd McLaughlin, who says he doesn't have a microphone, so we'll have to read it for him. I started my photography business 3 years ago and had a tough start with cancellations, got depressed, and took the second year out to study, working more part-time than my actual biz. Instead, does anyone have resources for a business advisor, preparer who specializes in my type of small biz?
E4All is an organization that you might look into.
I was going to say that or E4Ever, one of those, E4All or E4Ever.
Yeah, just go ahead and Google those organizations. E4All has a chapter in New Bedford. I'm not familiar with E4Ever, but that's a place that you can go to. Also, the small, I can't remember the name of it now, but there's a resource center in Fall River that has a lot of business seminars and whatnot that they put online.
There's also SCORE. I think they're still in New Bedford, and they're retired executives who can give you advice and some mentorship.
There's SBA in Fall River. They're on Pecasset Street. They still provide services and give seminars and other things.
Nice.
I have a question. I received an IRS form for unemployment compensation that I didn't receive. I received some. I mean, I remember the $9 check, but I don't remember getting $1,250 or whatever it was that said that I got. So I know this has become a common problem, which is kind of bizarre. What do you do?
Oh, was it for stimulus? Was it your stimulus money?
No.
It was unemployment? You got
unemployment. Yeah, I filed for unemployment, but it was like one of those things. I got laid off, but then I picked up another job. And of course, that new job canceled out the old job, which is a whole nother topic to discuss. But so I got a $9 it said, $9. And every time I go in and go in and check on it, it say, you're not eligible, blah, 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 blah. So now I get the form. I look back into my bank records and I found some money in there. But it doesn't jive. It's way more money than I looked at my, it's direct deposit and it's totally off.
I personally had my information stolen And so someone filed a fraudulent claim at the beginning of the pandemic. So I called them and, let them know, and okay, they put my case together, la, la, la.
Mhm.
3 weeks ago, the 1099 shows up for the income that I earned. There was a website on the form that you can go into and you can basically rebut it. And I did that. I went through that process. I said it was fraudulent, and I got a corrected one with the correct amount. So you would have to just go into that site and file a claim with them that says, gee, this isn't the right amount. You guys need to check it.
I actually tried to attempt that, but all lines are busy right now. And
No,
it was just a
did you
total
do
mess.
online? It was a web page.
All right. I went
Yeah,
through
there
in,
was.
I went in through mass unemployment instead of, I didn't see the link on there. All right. I'll do
Yeah,
that.
there was one, I believe, in the probably towards the bottom left corner, where you could go in and kind of file, I don't think this is right kind of a thing. I went through like the whole process, and I was actually very surprised. A corrected 1099 did come in the mail and it said 0 on it. So
Okay.
in your case, hopefully you'll get a corrected one with the amount.
Yeah, it's like, not like we don't have enough to do and enough hassles to deal with. It's just
Yeah.
kind of bizarre.
Just to make sure that you're covering all the bases before you rack your brain around this, is it possible that the difference between what you received and what that form reports as, the difference between the withholding that you had taken from it?
Oh, it's good. Yeah. Did you have withholding on it?
On $9?
Oh, $9. Oh, I thought you said
Yeah.
900. Oh, yeah. No, that's.
No. That's and again, all of my unemployment responses have been, you're not eligible for this claim period, blah 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 blah. All of a sudden, they tell me that I got, I don't know the number. It's been a couple of months since I received it, but it was like $1,200 or $1,900. Like, no way. And I went back over all of my statements, my bank statements, looking for a direct deposit. That I didn't, looking for direct deposits, not deposits I made, and it just wasn't there.
Oh, yeah. I would file it. Yeah.
All right.
But
All right. Thank you.
I'd like to let you know that Margot put the E4All and the E4Ever links in the chat. So if you're looking for that information, you can grab that out of the chat. We still have time for other questions if people have one while we're waiting for more people to type in.
Pamela is raising her hand. Den, if you could unmute her.
Okay, sorry, who?
Pamela?
Pamela. Okay, hang on a second.
No.
I just unmuted myself.
Yeah, you can unmute yourself. Yep. Yeah, I set it up so everybody can unmute themselves. So feel free to, when you want to ask a question.
So I'm still trying to understand the new tax laws that.
Don't try to understand them. I go through days where I don't understand them, and I've been doing this 20 years, so don't worry about it.
So I've been reading a lot of information from Hannah Cole, who specializes in taxes for artists. She's, $90 an hour. No, $90 for 30 minutes, but there's a lot of information to read online that she suggests. So what is it that, I don't even know what making a profit means. Is it after you pay all of your expenses? I mean, I'm a visual artist. Is it after you pay rent for your studio, all your supplies, and then after all of those expenses, you start to earn money?
Well, you would have you earned any revenue yet?
No, just, very little.
Okay, so you would, for tax purposes, okay? These are going to be kind of like two different things. For tax purposes, it's the dollars you brought in for revenues for your business for the year, less any expenses. So whatever art supplies that you need, or for the photographer for buying film and tripods and things like that. And then whatever the net number is on the bottom is what you're going to pay taxes on your tax return.
I used to be able to deduct my expenses when I was a professor because my activity as a visual artist was necessary for my profession. But
Yeah, so you probably, when you worked for someone else, you probably itemized those expenses. That is something that went away when they changed the tax rules at the end of 2017. So, and that's different. So that's like a different type of deduction on a different place on the return. So what we're kind of talking about here is, as an artist, how much money did you earn in 2020 as an artist, as selling your art or, whatever? And then what expenses did you incur against that? You bought supplies for this. Maybe you shipped something to someone because they bought it from you off the internet. And so you spent money on postage or what, all of that are your expenses for your business. And whatever the net number is on the bottom is what you pay tax on. And now what Lisa was talking about, if you have more than 3 years in a 5-year period where that number is a negative on the bottom, that's where the service kind of comes back and says, this isn't a business, this is a hobby. And you can't take the loss against any other income. So, it gets a little hairy after a couple of years if you don't earn a profit.
I mean, I've been doing this for, 30 years. Deducting. I mean, occasionally I'll get a grant. Occasionally, I'll sell to a collection, a museum collection. But most of the time, I don't make a salary because I have so many expenses to continue with what I do. Have you consulted with experts, art consultants? Are you a seasoned, educated artist or a dabbler? Do you keep records? Do you carry your activity in a business-like manner? Do you depend in full or in part on the income as an artist? Do you apply for grants? Do you have a website? So, I'm a legitimate artist. I've been an artist for the past 50 years. And I'm a retired professor. I'm just, trying to come to grips with the fact that I cannot deduct, my expenses.
Well, you can deduct your expenses against what you earned, but if you were not, those deductions went away on the Schedule A a couple of years ago. So if you were prior to that, absolutely. And again, there were limitations on the Schedule A for you to itemize those expenses. But yeah, you can't take beyond what you earned at this point.
Yeah. Well, I'm still coming to grips with it.
Okay, yeah. Barbara Healy has a question. Barbara? I'm trying to find you in the scroll here.
Looks like she's unmuted right now, so I don't know if we can hear
Yeah,
her
she
in
is
the background.
unmuted. It doesn't look like she has she's unmuted. Barbara, can you? All right, I will read her question then. She says, for sales taxes, your gross sales or your gross income? I sell paintings, but also teach painting as income.
Your sales tax is charged on what you sell for goods, not services. So that is one of the, remember how I was talking about in revenues, you want to you don't really need to have too many categories. If you sell goods subject to sales tax, I suggest you have a sales of goods versus a sales of service revenue category, because it would be really helpful for you. You do need to file and pay your sales tax on all of your sales, and then the services would be tax exempt. So you'd report your total sales, and then you'd say what are the ones that are not subject to sales tax, and that would be all your service income. And sales tax, then it's never, by the way, sales tax is not your income. It's not your income. It's not your revenue. You are just a facilitator collecting that for the state. So it's not an income or an expense for you. It is strictly honestly, a liability and a cash transaction for you. to have to manage. Does that sort of answer your question?
And also make sure if you're selling things that you actually collect the sales tax, because you owe it whether you collect it or not.
Collect it and then remit it. And so you've got to file with the state. In most cases, most likely Massachusetts, you need to file, you need to register with them so that you can file. The other thing is that depending on how they have categorized you, for instance, probably as a quarterly sales tax filer, regardless if you have any sales, you have to file a 0 sales tax return for periods where you have no revenues. They will come back for you. They will send you hate mail, I promise. They will assess a number, throw some penalties and interest on top of it, send you a nasty gram.
So sales tax is a quarterly transaction that everyone needs to be worried about.
Not everyone. So it varies. So some, depending on how much, and there are rules in each state, but depending on how much you collect in sales tax, and there are thresholds, you could be a monthly filer, you could be a quarterly filer, or you could be an annual filer. So it varies depending on how much you collect. And when you file, you basically tell them how much you think you're going to collect throughout the year and when you're going to collect it. And then they make assessments based on what you think it's going to be as to how you file. So you don't not file just because you had no sale. You have to file what's called a 0 sales tax return, so that you close out the sales tax number, one or the other. But you can't just file and then never file again.
Again, another good reason to have a tax preparer that help you with these kinds of things.
I've actually had a client that didn't file. They thought they were going to collect sales tax and didn't need to. And 3 years went by and the DOR actually froze this woman's bank accounts until she filed every single month with zeros. And I closed out the tax type. So the DOR is very serious about sales tax. Don't monkey with that.
Yeah. Payroll taxes and sales tax. That was never your money. Never your money. So Uncle Sugar wants it or the state wants it. It was never yours. So that's one of those items that, God forbid, you end up in a bankruptcy proceeding. Sales tax and payroll taxes do not go away in a bankruptcy proceeding. You owe those. You're on the hook.
Lisa Aldrich, you mentioned in your initial presentation the difference between an employee and a contractor, and 1099s versus payroll. Another issue that has come up with our business times is the difference between somebody being a contractor and a vendor. Could you give us a little bit of information about those things?
When you say a contractor and a vendor, what do you mean?
That paying somebody who is registered as a business is like treating them like you're buying, art supplies versus buying a service from somebody where it may be a 1099 transaction.
You do have to review all of your business services that you purchase, whether they be rent or a good or the services are usually rent somebody to repair your studio or expand it. Things people you don't really think about. You really understand the people that come and work for you as subcontractors. Those are pretty clear. Usually people remember those. If you have a yoga studio and you hire teachers to teach your classes, that people remember those and they 1099 those. And then I say, well, what about your landlord? What about the person that expanded your studio? What about the accountant? What about the lawyer? All of those people are required. If you pay them more than $600 and you have a W-9 that says they are not incorporated as an S or a C Corp, you should be issuing them a 1099, either an NEC or for rents, it would be a miscellaneous. Is that a little clearer?
Yes. Does sole proprietor fall into that, or is sole proprietor automatically a 1099?
A sole proprietor would be an automatic 1099, NEC. So anybody that's not incorporated, yes, you're going to be giving them an NEC form. that they're going to be reporting. Honestly, it doesn't cost you anything really to issue these forms out. And a lot of people think that they can just, oh, well, I can just pay somebody cash and we don't need to report it. That's great. Don't do that. It doesn't cost you anything to issue a 1099. And they should be reporting it on their taxes. And that's really, unfortunately, the IRS has made you the bad guy, where you have to inform on your people that you pay. That's sort of that's why it's there. You actually have a box on the tax return that you have to certify of whether you were required to send 1099 forms. And if you were, did you or will you? So you actually have to certify to that, as does your tax preparer if they're signing the return. So it's important to just get those ones right and make sure that you're issuing them.
Okay. Barbara, I see you have a question, but I cannot turn on your audio. I don't see you even having any audio, Barbara Healy. And I don't really understand the question. Can you turn on your audio to ask it? And in the meantime, while you're finding your audio, Betsy, you have another question?
Unmute myself here. So I participate in an art gallery sale, like a holiday market. They pay sales tax on any items that are sold. And then they cut me a check for 60%. That the way they make money is they keep 40%. Do I count that as income, and do I owe sales tax on the money that's already had sales tax paid on it?
In short, no. If they've made the sale, it's interesting. The same thing really applies for 1099s. If you paid somebody for somebody else, you have to issue the 1099. Kind of interesting thing there. So in your example, if the gallery paid, I don't know, somebody for you, then they would issue the 1099. Same thing with the sales tax. They're remitting it. So as I see it, Lisa, you can chime in if you think differently. But what I would say is whatever you got, that's your sale. So if you
I would agree.
Yeah.
I would agree. Whatever the dollars that they gave you, like they net you, that's your income, not the 100%, because it sounds like the funds went to someone else first and then came to you. So to me, it just seems like it's a net.
It's a finder's fee to her, not a sale, like a commission, basically, not a sale.
Yeah.
So not income then, if it's a commission?
Well, it's still income to you, but I would say it would just be, it's the 60%, right? I mean, to me, it seems like it's the 60%, not 100% with a 40% expense.
Right.
And if it's more than $600, they give you a 1099 and you report that as
So
straight
it's
income.
less than 600. So
you still want to report it.
You should report it, even though they don't send you the 1099.
Yes. Keep in mind depending on how you operate with some of your vendors, they may not physically send you a 1099 anymore. A lot of people, you've got to go into their portals now and download them. And I've had that. Well, no, I had that. I had to represent a client who got a hate letter. And he's like, well, I didn't get a 1099. I'm like, the 1099 was in your portal. They submitted it to you. Just because you didn't download it and put it on your tax return doesn't mean anything. Sorry. Okay. You get nothing.
And to that point, even if you sell something for $500, I would tell you to report it. Don't try to get cute. That was sort of where I started with that. Don't try to get cute with your income, and certain expenses. It's not worth it. It's especially if it's an electronic transfer or if it's a deposit into your bank, it's going to be really traceable in case of an audit. So make sure you report it as income.
Yeah, I
there
agree.
are plenty of expenses out there.
You don't want to pay either one of us to represent you because it gets incredibly costly. That's where you realize how much money it costs. It's like you're paying for some good representation. I'd say 2 to 4 bills an hour for good representation. That's like $200 to $400 an hour. And these things drag on for 12, 15, 17 months, sometimes over a period, and it gets incredibly costly. So That was my example at the beginning. Had she paid someone, didn't have to be us, $400, $500, $600, $700 to do the tax return the first time, it wouldn't have cost her $13,000. And it's just, I'm a firm proponent of what you get, what you pay for. There's cheap everything's out there. So just be mindful. There are going to be inexpensive preparers. There are going to be expensive preparers. You get what you pay for. You know, we are knowledge workers. So in most cases, you're paying for our knowledge. Similar to those of you who have been artists for a long time, you get more, there's more value in the work that you do. And so it's really the same concept. It's just, you know, it's you get what you pay for. So just be mindful of that. When you know, when you're like, oh, this is expensive. Well, is it at the end of the day? So.
Okay, Barbara has turned her audio back on. So Barbara, if you unmute and ask your question, that would be great. Go ahead, Barbara, just talk.
I'm going to guess that Barbara's probably talking on the other side, the poor thing.
Well, her microphone is on now. It's not muted anymore, but I'm not hearing her, and she won't jump to the front if she's not. She has her video off, but we should still be able to hear her. But turn your video on too, Barbara.
She may have a connection problem, so.
I was going to say she may have a sound connection problem.
Yeah, might be. All right, well, I will try and.
Oh, there she is.
Okay.
Audio still not
Oh,
working.
yeah, no, we can't hear you. Oh, bummer.
Okay, well, in the chat, it says, I subtract my gallery sales from sales tax because they collected them, but the gross should include service, then deduct them as not subject to sales tax.
Is this something like Betsy's situation where they collected it?
I believe she's talking about the same thing where she's selling
Okay.
through a gallery.
Okay.
The gallery collects the sales tax and pays the sales tax on the transaction.
Yeah, because the buyer's really buying from the gallery. They're not buying from you. And so the gallery is in turn paying you a commission for your work or is paying you for your services. And so that's, yeah, that makes sense because the actual transaction is with the gallery and the individual, not you and the individual.
Are there other questions out there? All right, well, we're getting to 7 o'clock, a little after 7 o'clock. I'm going to push the poll out. I would hope that you will take the poll. It's short and it's very helpful to us. We can still take questions while the poll is out there. Okay, so you should be able to see the poll and participate in it as just by checking things or answering the questions. While that's going on, if there are other questions, please type them in or unmute yourself and ask the question.
Oh, poor Betsy. She says very overwhelming. Oh my goodness.
Well, it's a lot of information, but you know, taxes are taxes and accounting is accounting. It's a specialized thing.
It's not nursing. Uh-huh.
Yeah, very. It's different. And honestly, if you did work for somebody else, it's a whole other piece to the return you probably never had. You'll see other pages on it that you never did, and it's a big. It'll actually look different too. So it's a lot. It's a lot to take in. Again, Lisa and I do this for a living. Like I eat, breathe this, and so. I get it. Like if that's not what you do, you're like, I just want to sell my art.
Exactly.
Jenny May Coe has a question. Unmute yourself and let us know what it is.
Hello.
Hi.
There you go.
Hi. Thanks so much. I'm curious about taxes for grants and awards. Like I'm in the process right now of applying to different grants to support some projects and, putting my work out for like, contests or awards and things like that. So how is that managed, like as income or, yeah, I was reading the IRS site and it seems like some of it's not taxable. So love some clarification on it.
For the most part, any grants you're going to receive as a for-profit business are going to be taxable to you. The one probably excluded would be the PPP and the EIDL from this last year. If PPP, if it becomes forgiven, an EIDL grant is not taxable, but for the most part, those grants are going to be income to you, unless you are operating as a not-for-profit, then that's completely different.
One thing to add to that is that the Massachusetts DOR has come out and said, oh, wait, yeah, we know that the federal government has said that the PPP is not taxable, but the Mass DOR is considering it is taxable at this time when it appears on a personal return. And that can be income related to being a sole proprietor, being an S Corp, or being a partnership. So just be aware of that. You might want to put off filing your personal return if that's your situation and you've had the forgiveness happen in 2020, because there is a movement afoot to get the Massachusetts Congress to get that changed. And
yeah, not in the spirit of the of the grant, right? Yeah, they're making it very challenging for us.
Since we already mentioned an organization like E4All, I know for a fact that E4All does have some grants that they give during the process of being in their organization as a fledgling business. And if you do qualify for one of those awards, you will get a 1099 for that award. So that's just one example of how these things can be taxable.
I was looking at the, thank you so much, by the way. I was looking at the IRS website right now on, I guess I'm looking at grants to individuals. So I'm still sort of figuring out how to transition from kind of being just filing as an individual with a job to doing this as a full-time kind of career in business. So forgive my ignorance to all of that. I have to turn a profit before I become technically a business. So is that how it works? Or
no, it's not that you have to turn a profit before you become a business. That's part of why they give the rule of 3 out of 5 years. It's expected that when you're starting up, there might be a time when your expenses exceed your income, and that's okay. And it's not a problem even if it happens one, a random year here and there. But I think one of our participants said it very well. She said, "Are you running it like a business? Are you, do you have a website?" There are a bunch of rules to it. Profit is absolutely a piece of it, but there are some specific rules that you should really think about. And if you're running it as a business and your intent is to make profit, just because you don't make profit in a year doesn't disqualify you from using a Schedule C.
Awesome. Thank you so much.
If having a Schedule C myself, if you lose money in a particular year, that also gets written off against other income.
Yes. Yes, it does.
Which is why they don't let you do it forever.
Pretty much.
Okay, keep filling out that poll for us. And are there any other questions?
Ron, did you change your mind?
You're on mute, Ron.
Den asked the question that I was going to ask. Actually, I was also going to ask, at what point are you just better throwing it in and saying, and just declaring it as additional income? It's a hobby, money you made from a hobby, and just leave it at that instead of paying your bookkeeper to go through all that just to find out you didn't make any money anyway, which you already know. Does that make sense to you? you're at your hourly rate. It's probably just better than say, okay, well, I made $1,500 this year after everything was all said and done. That's it.
So I would say if with all of the tracking now out there, electronic, PayPal, eBays, all of that, you're getting 1099Ks from all of these guys.
Right.
Even if it is a hobby for you, you still want to report the income.
Yes.
And then the capacity for expenses and like basically a net zero on there.
Yeah.
Because what you don't realize is they do a lot of ticking and tying of those numbers. Okay. So they're looking for a lot of those forms that are filed with them. They're looking for the corresponding item on your return. And so, for instance, I had a client, I had no idea they had a brokerage account until she got a notice and she had her head on fire. She's like, oh my God, I got a notice. And I started to go through it and she had an adjustment. I was like, you have a brokerage account? You never told me that. And, oh yeah, we buy, he was buying and selling something on a stock or whatever. And I was like, okay. And so they're ticking and tying those pieces and looking for them on your return. And when they don't find them, that's when they send notices. So sometimes you just want to get ahead of it. And just, especially with the 1099, what used to be the MISC and is now the NEC, they're going to be looking for those in some fashion on your return. So I would recommend.
Just do it and claim the loss then, basically.
Well, if it's a hobby, it's going to be just a net zero.
Oh, okay. All right. Yeah. So in other words, you just have to tabulate everything. To put on the up and up.
Yeah.
The other question quickly is the Trump tax plan, quote unquote. I had never had to pay out before. And I had returned from Portugal. So there was there wasn't really there was no income really made in Portugal. Plus I had to deal with their IRS, which is a little different, but I did everything, put it in under the assumption that I was going to get a little bit back or something, cover, like a wash at the very least. And I was like, what? Well, I also got remarried. So I guess that changed a lot of things as well. And
well, yeah, you went from being a single filer to a married filer, and that changes. Now you've got aggregated incomes. That changes your whole story.
Right.
And the Trump stuff, honestly, what the problem is the service didn't change. The service changed the withholding tables. And that's what spanked everybody in that year.
Yes.
Is everybody was getting $27 more in their paycheck every week. And now suddenly $27 over 52 weeks. And that's your $4,000 refund. You're like, well, where's my refund? And so a lot of people didn't have an increase in tax. They had a decrease in the refunds because of how they were getting their money every week. And so you've got to be mindful of what your withholdings are and checking them on an annual basis to ensure that they align with your tax picture.
That included Social Security because I'm semi-retired.
Social Security.
I should have increased my withholding on Social Security.
If you have other taxable income, if you have other earned incomes.
Well, that was.
And that's the problem. Social Security over certain thresholds now becomes taxable to you. For a 78-year-old person who only has Social Security, no, they're not paying income tax. But if that person has a 401k from here and a little bit of IRA money there, you start to aggregate all of that together and you hit a threshold. And that's when the service says, oh, you hit, I think it's 30-ish thousand or so. And it starts to adjust from there. So anything over 30,000 in earned income somewhere else, now your Social Security becomes taxable. And so those are the kinds of things that you have to keep your eyes on because that can shift from year to year. And that's what changes your taxable picture from year to year.
All right. Now my wife turned 65, so she had to go into Medicare. Is that going to affect our taxes now? Because last year she's still working, nothing's changed there. But it's just kind of bizarre. Like you could be on mass health until you're 64 because you're not making enough money. Yet when you turn 65, magically you can give the government $1,400, for health insurance, which is kind of bizarre. But will anything change as far as that's concerned?
I mean, if nothing else in your picture changed, she's still working.
Still working, yeah.
She's most likely not drawing. If she's drawing Social Security, then keep in mind that Social Security is probably going to be taxable to you.
Yeah.
I mean, that's, I mean,
so
I'm
that's
just
something
kind
we
of,
should consider for the next tax season if she decides to. What is it? 66 in 6 months is generally like the best rule of thumb to apply.
there's no rule of thumb. Eric will tell you everybody's picture is specific. You've got to talk to whoever you work with and ensure that like you're drawing like at the right time for you.
Yeah, it's based on your age and your year of birth. And at some point, it's 67 for everybody. But if you're in that bracket, there's a number of years where it varies your full retirement age. And I was actually going to bring this up, Ron, so I'm glad you mentioned Social Security. If you are collecting Social Security before your personal full retirement age, and everyone should look up the table, it's easy to find, and find out what their full retirement age is. You're not only potentially getting your Social Security income taxed, which really isn't that big of a penalty. It's a relatively low amount of tax for most people.
Mm-hmm.
The real danger is having your Social Security reduced because you're collecting before FRA, full retirement age, and make over a certain amount of money. And that certain amount of money is pretty darn low.
Yeah.
Oh, it's like 16 or 17,000 or something. It's crazy.
Yes, it's that low, and it's personal. So your spouse doesn't enter into that equation, which is the one advantage of that there is in filing jointly.
Right.
It's not a disadvantage anyway. But that's 50 cents on the dollar for every dollar earned over 17,000. It gets steep real fast.
Right. Yeah, I remember now. My FRA was 67. The omnibus bill killed the file and suspend, so that plan went up in smoke.
Yep.
And I do remember they were very helpful at Social Security. I was really shocked at how helpful they were.
It's
And
hit or
so
miss.
you apply for the FRA
I agree.
six months prior. Well, Mrs. Oliveira, I'll throw a pitch out for her. She was really, really, very helpful. But it was, I think the rule of thumb was 6 months prior to FRA is when you apply for it.
Yeah, because sometimes
with
it can
my mother.
take time to process, and that's simply why. I mean, if you process on the month before your FRA and you tell them you want it to start on your FRA, you may not get your check on the day of your full retirement age birthday.
Exactly.
But they'll give you a back check. They'll make you whole.
That's what they did.
But yes, it's smart to do it 6 months in advance, and that way you don't get caught in a line.
Right. Okay. Thank you so
The
much.
Social Security planning is very complicated. I have a service that I have basically at my fingertips where we input people's information in and look at every of the possible, all the possible angles. Filing early, filing on time, filing late, and then extrapolating that over time to find out where the crossover points are for which methodology is best for you.
Right. I bought the Solomon book.
Say again.
I bought the Solomon book, the everything you needed to know about Social Security. But the weird thing is no sooner did that last edition come out, the omnibus bill came out, and then bang, 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 everything. So they just had to do addendums, and then I think basically they just said, screw it, just go to the website.
Yeah, and that's why the service that we have, that I have available to me is so great, because their people are trained on all the updates, and it's something that I don't even want to be trained on. And that's why
It's a
we've got the
specialty.
service. It really is, and there's a lot of caveats in it, and it's important to make that selection carefully. Oftentimes, a lot of people say you should collect early because you can't take it with you, and if you die early, then you get nothing, and your family gets nothing for it, more or less. I mean, there are widow's benefits, but that's a whole other conversation. But but if you have good longevity in your family and you can wait to collect, then the math says you're better off waiting to start collecting. but by waiting, you're giving up to 3, 4, 5 years of Social Security
It was like
payments.
8%.
And it's an 8% increase for every year
Right.
you don't
Right.
collect. But if you have good longevity in your family and you're currently healthy and you have other assets, the math says wait until you're 70.
Yeah, that kind of works against you too, because my mom's 94 and her her retirement from the union, she outlived it. So, and then my stepfather died, and so it's just like, you know, you're gonna it's not gonna be perfect. Let's put it that way.
It requires a lot of planning. That's what
Yeah,
people
it
don't
does.
understand.
Yeah.
You don't turn 65 and you're like, hey, let's do planning.
No,
You
and
really
even
need to-
even when you do planning, like I was all set to go for the file and suspend, and I think I missed the cutoff by, you know, based on my birthday. I was like, are you kidding me?
Yeah.
Because that would have
Just
been, you know, at that time, that would have been perfect, because at least that money would have been accruing. I would have been losing that 8%. And then it would have been, when I decide to pull the lever, you get everything plus interest on top of that.
Yeah, well, you can
So-
see why they pulled the rug out from underneath that one, because it was really a scam, and it was a complete manipulation of the system, and we were using it as well, and it was sad to see it go, but yeah, the Social Security decision is pretty complicated, especially if you're collecting before full retirement age. So for the purposes of this discussion, I think it's important for everybody to realize that if you collect before full retirement age, there are other things that you should be looking into and seek help to figure out which is the best. Because I could tell you all the rules you need to know right now, but you'll forget them as soon as the thing is over here. So just know that full retirement age is something you need to pay attention to.
All right. Thanks so much. Much appreciated.
Okay, well, I think we're starting to lose people out there, and I think we've covered a lot of ground, and we're well into the past 7 o'clock range. So I'd like to really thank Lisa, Eric, and Lisa, and thanks Margot and Ashley for all the help in the background there. I hope you'll follow Practice Best Practice and sign up on our email, and that we'll see you for the next workshop, which will be announced soon. We'll be meeting to make some decisions and lay out some information for another one coming up. Thank you all.
Thank you. Thank you for having us.
Thank you very much.
Thanks. Great questions, everybody.